Hey, good evening. Good evening. We are live and direct. Today's topic, tonight's live, is definitely going to be one where you can ask any questions you have pertaining to home ownership, whether you're a first time home buyer, whether you're looking to be a second time home buyer, if you have questions about refinancing, HELOCs, because you're still a buyer as well. You can ask questions pertaining to the markets, price, housing prices. We're going to dive in, and I'll answer any questions you have. I'll give you market updates as to what I'm seeing in the market, changes that I'm seeing in the market. And it'll be an opportunity for you to answer, get any of your questions answered by me. Here with you guys. First of all, June is National Homeownership Month. Um, uh, June is National Home Ownership Month. I can't even talk. So I want to get the questions answered for my homeowners. Christine Lambert, welcome. The great state of Delaware, my home state. I appreciate you joining us live tonight. So first of all, let's kick it off with the market. So right now in the market, private. So real estate is regional, right? Even in my lives, I'm discussing what I see on a market whole, but it's also a regional market. So, example, do you know what's going on in, let's say, per se Delaware, what that market is compared to, let's say, a Philadelphia, even though they're close together, are two different markets. The same with Georgia. You could be in one part of Georgia, let's say the Atlanta market, and you could be in middle Georgia area near Warner Robins and Macon, and there'll be two different markets, right? So everything is pretty much regional. On the whole, mortgage interest rates are still up. They're going back and forth. Some days they're down, some days they're up. And when we speak about the market being up or down, we're talking about interest rates, right? And not necessarily the actual rate of 6.75, 6.5%. It could be what the cost is to get to that 6.5 or 6.75%. And that's key. And that's something that I had a buyer reach out to me. We sent over some documents. The interest rate for the particular program was 6.75 based off where she's located, where her credit score is, housing prices, and then the cost to get that rate, right? Um, she is she saw rates lower somewhere else, and we had a discussion about it. And essentially, what it was that was like a teaser rate. Like you technically, without having an application on the person, and having personal information and data, you really can't quote rates. So that could be a national average. That rate was based off someone with a 740 credit score, and 20% down, and she didn't have either one. So when people see rates, they say, "Oh, the rates are here, the rates are there." The rates are dependent upon you and your situation. If you're a 580 credit score, and that's not what she had, but I'm using an example. If you're a 580 credit score, if you're a 580 credit score, you can't expect to get a seven. I mean, can't expect to get as the same rate as someone with a 740 and 20% down. So you just want to make sure that you are being realistic in what you're looking for. Being realistic in what you're looking for. Something else that I'm seeing in the market is housing prices, across the board are remaining steady. I can do all 50 states, and I have clients or buyers who call me in majority of those states. Never had anyone call me from Alaska. I mean, your market in your metropolitan areas are still a little bit on the elevated prices and the elevated side. When I say market area, I'm referring to, I mean, metropolitan area, I'm referring to like Atlanta, Houston, New York, Los Angeles, Chicago, certain parts. Miami, certain parts of the country that are a little bit more expensive. And real estate's a little different in those areas, right? The next thing is being realistic in what you want your housing payment to be. I'm running into a lot of situations where buyers want to qualify for more house because of the market or because of what they need. However, they don't want to pay what it costs to get that house. Example, I had a buyer that was qualified for, $400,000, and they wanted to know, hey, this is what I need for my particular situation and family and in the area I'm in, but I don't want my payment to be over $2,500. Well, that doesn't equate. $2,500 a month on a $400,000 house is not. That's not the payment. Rates would have to be half of what they are to probably even get that. To be able to get that interest rate. So just being realistic. And if you want a $2,500 a month payment, that's fine, because that is a lot of money per month. But you can't get a $400,000 house. And if you qualify for $400,000 and you want more, but you want a lower payment, there's no way to get that higher payment, simply because you are not going to you're it's no way to stretch out the payment. Typically people can equate it with a car note, right? On a car note, you go to the car dealership and they give you, hey, your car payment is $700 a month for 60 months. And you said, oh, I was looking for my payment to be closer to, let's say, 550. Well, they could stretch it out to 72 or 84 months, which is a longer period of time, which makes your car payment lower because it's stretched out over a longer period of time. With mortgages, we initially start out with 30-year fixed. So there's not a mortgage for primary residences beyond the 30-year fix. Typically that's 25, 20, 15, 10. That makes the payment lower. That makes the payment higher for a shorter period of time. So when you're getting pre-approved for a house, you just really need to be realistic. And I get it. When we qualify a borrower, we qualify them off of a gross income. However, you guys see your net, meaning you see what you can afford based off of after you've paid taxes, after you've invested into your 401k or IRA from work, after you have paid health insurance. You're thinking about, okay, I've got childcare expenses. So you're looking at that from the net expense, and we're looking at it from the gross. That's how we're able to qualify you for more, especially if you are a W-2 employee. If you're a self-employed borrower, which is totally different, we typically look at your net, because we look at, okay, what can you qualify for after you have paid your taxes to the government, right? What did you write off and say that, hey, I made $150,000. However, I wrote off $75,000 in expenses. So my income is based off of $75,000. So we look at the net from that standpoint. And yourself, your budget, but you also have to be realistic in what you want in terms of a house, because you can't qualify for more if you have a budget of where you want your mortgage payment to be. And then you also have to be realistic that we can't qualify you for more than what the FHA, VA, USDA conventional guidelines will allow. You can't qualify for a $500,000 house with a $50,000 a year salary. It just doesn't equate, and it doesn't make sense. We don't want to put anyone into a house that can't qualify for the house, and we don't want the house back. So we are only going to go up to the guidelines based off the particular loan that you're using or that you qualify for, and nothing more, nothing less. And then you got to understand that you could also, this could be your first home, and it doesn't have to be your end home. Doesn't have to be, you don't have, because it's a 30-year mortgage, you don't have to be there for 30 years. You can be there for 5 years, you could be there for 10 years, and then you take the equity from that property, And when you sell it, if you sell it, you take the equity from that property that you purchased, and then sell it, take it, buy another home, and then you can upgrade at that point. Or you could potentially, take the equity further ahead of time, and then also once you take the equity from further ahead of time, when you refinance, you could keep that particular house for an investment property and take that money and use it as a down payment so you can buy another house. Again, guys, if you are just joining the live, if you're new to the channel, do me a huge favor, hit the thumbs up button. We've got 8 people watching. I should have 8 likes to this video. If you're out there and you have questions pertaining to home ownership and you want to get them answered, I'm here to answer them for you. Right now, Christine Lambert has a lot of questions, so I'm going to jump in. And if you guys have any questions, go ahead and if you guys have any questions, go ahead and chime in. If you're watching the replay and you have questions, drop them in the comment section and I will get them answered. My contact information to reach out to me or schedule a call with me will be below in the links below after this live, and I look forward to working with you. And the first question, do you know where I can find a rent-to-own option, please? You would probably have to get with, not probably, you would have to get with a real estate agent. My question would be to you is why a rent-to-own situation? So rent-to-own sounds great. Sounds like, okay, I can rent this house, but I can eventually end up owning it. Over 20 years of being in this business, rent-to-own options typically don't go the way that the buyer expects. Why? Because now with rent-to-own options or lease purchase options, you're going to have to already have spoken to a loan officer that says, hey, this person can purchase a home after X amount of years, right? Let's say 2 years. You're in there paying on the house. And most of the time, the mindset is, oh, this is my house. I'm going to do this, 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 and that. 9 times out of 10, on my side, I've seen the buyers not be able to purchase a house because they've never executed on the game plan that was given to them to put them in position to purchase the home. And the other part is because you're sinking money into the house because now it's technically in your mind, it's yours. You're not able to save and you haven't fixed your credit. Now, if you had to be on your job for a specific period of time before you could take over or get a mortgage on that house, that's a different story. But if you have to fix your credit, you need to be dumping your money or your energy into fixing your credit so you can become a homeowner. But lease purchase rent option programs, you would have to get with a realtor and see if there's anything, that they can find or on the market that's off. I mean, that they all can offer you. But I would always suggest to see if you can purchase ahead of time because rent with option to buy is not necessarily a better route or cheaper than purchasing a home. Okay, it says I'm in PA. Yes, willing to relocate to Delaware, Maryland. Um, do you offer consultations, counseling, credit repair advisement? Yes, first thing I would do, Christine, is jump on a phone call with you. I'll jump on a phone call with you and see what it is, what your situation is, and see if I can help you with your needs for credit. If it's above my pay grade, I have a credit repair company that I potentially refer clients to. It's up to you whether you want to invest in that. There is an investment, meaning they do charge, but it's an investment that you can make into yourself, and that's exactly what it is. It's not necessarily another bill. It's an investment to improve and put you in a situation where you can purchase a home. And I would be glad to grab a call with you. I will put my contact information in the chat. Well, not in the chat. It'll be below after this video. You can reach out to me. Actually, I'm going to put my email address here. My team is off today. Uh, Send me an email so you can schedule a call. I don't have my calendar link readily available. Thank you for the super sticker. I appreciate that. I think that's my first one. First time home buyers, do they still offer grants, financing, FHA, and conventional? Yes. So, I mean, there's still programs out here for first time home buyers. There's some grants from municipalities. There's, FHA, USDA financing. It just depends on what you qualify for, how much you qualify for, and if those programs are make sense for you to participate in. Also, in terms of a lease purchase or rent to own, you can't use the down payment assistance for those programs to get into them. Afterwards, when you're actually physically purchasing that property, yes, you can potentially use them. Um, I'll keep going. Do you recommend a pre-approval first to see what you may qualify for? Our first home would definitely want to be long term. Yes, I mean, no agent is going to show you, no experienced agent, I would say, is going to show you a home that if you're not pre-approved for. So the first step would be to see about getting you pre-approved, how much you can get pre-approved for, what programs, and what type of money you have. Do you have, if you qualify for a down payment assistance program, that does not necessarily mean that you don't have any closing costs that you need to pay. There's going to be some costs associated with purchasing a home, even though you're a first-time home buyer. Just three things up front that you definitely would have to be paying. You would have to pay an earnest money deposit, which is consideration being put down on a contract when you're looking to put an offer on a contract and get the house locked up so you can purchase it. You have to pay a home inspection fee to the home inspector because you would like for the home, whether it's new construction or existing construction, heck, if you're living in the house, you want to make sure you do a home inspection because the home inspector is going to inspect the house to make sure it's up to par and it doesn't have any major defects and it makes sense for you to buy. So you definitely want to do that. Home inspections, depending on where you are, can run anywhere from $350 to $500. It could be in excess of $500 if it's a larger home. That's the second upfront cost that you make. And the third upfront cost that you make is once you've put the house under contract, you've had your home inspection, and your home inspection is fine and you want to move forward, then you have to pay for the appraisal. Appraisals cost anywhere between $550 and $650, depending on the size of the house and location. So, right there off the bat, we're going to say anywhere between $2,000 and $2,400 that you'll have to pay upfront for upfront costs. So you definitely want to be able to make that. You can't put the home inspection on the settlement sheet or the CD. It can't be paid at closing. Neither can the appraisal. So you want to have money set aside for those three items in order to be able to move forward. See what other questions you got. Yes, you can schedule a call with me. Send me an email. I posted the email below. It says I've been at my new career going on 2 years. Well, that's great. So that's good that you've got a consistent work history over the last 24 months. And Christine, no problem. Thank you for jumping on. Thanks for helping me out, asking these questions, and I look forward to working with you. If you have any, I know there's questions that you may want to ask that are probably personal. Definitely send me the email and send me the email and I will get on a call with you. I'll send you my calendar link so we can schedule a call and talk about how I can help you. And also, I'm sorry to hear about you and your identity theft, but hopefully all's well and works out, and whoever did it gets what they got coming to them. Morena 487, happy Sunday. When do lenders do employment verifications called during the closing process? Is it done more than once? That is a great question. It is done more than once. So initially up front, when I can speak for me and my team, when I pre-approve a borrower, we look at you know, pay stubs, W-2s, bank statements. Bank statements tells us, hey, they're getting deposited into their account for their job. Most recent pay stubs that we ask for said, hey, looks like they're still currently working at their job. And the W-2s gives us a work history of how long you've been on your job along with what you put in the application, right? So in some cases, we do a verification of employment up front during the pre-approval process because sometimes we don't know how the income is broken down. Meaning, how much does this person make? So example, if you are a nurse, because they have tricky income. If you're a nurse and you work 36 hours a 36 hours a week, but you get shift differential, and your shift differential is part of second shift, part of third shift. So that's three different type of pays right there. Then you get overtime. It's easier for us to reach out to your employer to get a verification of employment and have human resources break that down for us, right? Let's say we've done that once. Then as we go through the process, since we already have the employment verification of employment, when we're towards the end, between 3 to 5 days before closing, 3 days before closing, we reach out to at least 3 days before closing. We reach out to your employer and say, hey, is XYZ Smith still currently employed at your job? Sometimes we get it in writing. Sometimes we do a verbal over the phone just to make sure you're still employed and that nothing has changed. So it happens multiple times, minimal twice. So we do it initially when you do, if you have simple income, we do it once you're under contract, and we do a verification of employment. You're still on that job and how much you make, so the underwriter and processor make sure that their calculation of income is equivalent or greater than what I've calculated. And then we do it again towards the end when you're nearing you're clear to close, which means, hey, we've almost got final approval. And those are one of the things. In order to get final approval, we have to do a verification of employment just to make sure you're still working at your job. Hopefully that answered your question. If I have a large sum of cash, but it's not in the bank, what is a time frame to have it in the bank before underwriting? Um, so, any type of cash that you have has to be verified. If it's verifiable cash, you definitely want to have it in the bank at least 60 days before, 60 days before getting approved with a lender. Um, because we look for the two most recent months of bank statements. But the cash is going to have to be verifiable. They still may ask for, a money trail of where it came from, and just be aware that they're going to potentially ask you 50 million questions because they want to make sure those funds are legitimate to use, that they're not illegal funds, that they didn't come from the seller or any other interested party in you purchasing the home. And they do that on all deposits outside of your traditional work, money that you get from your job. So, you just want to make sure you have it in the bank and be prepared to get a lot of questions asked on you about that particular cash so that they have an understanding of where it came from and that, everybody knows it's clean and make sure there's nothing funny going on with checks and balances. All right. What are some not so obvious red flags for approval that borrowers overlook? And that's a great question. So, um, not so obvious red flags. Not so obvious red flags is example, not disclosing if you have a car, meaning you may have a car or some type of bill in someone else's name, and we constantly see 550 going out every month. to something, and the underwriter is probably going to um, question, where's this 550 going? Um, we've been seeing it a lot on Karma, Affirm, things like that that don't show up on your credit bills, that don't show up on your credit. Buy here, pay here, or buy now, pay later. But we question it, and it's going to have to be counted, potentially be counted into your debt to income ratio, depending upon how much longer you have in payments on that particular bill. So if you're using Karma, stop. And you're looking to purchase a home, stop. Try to figure out how to pay that bill off as fast as possible, so you don't get scrutinized, and they're going to find it because they're going to come. We comb through your bank statements to make sure that we're counting all the debts that we can, because it's still a debt, and we just don't know if we don't see it. But if we see a pattern of things being paid, then we question what that is, where is it going, and what type of bill this is, and then we get documentation from you on that bill. We get documentation on that bill, and then we have to do a third-party verification of how much the balance is on the bill, verify what the payment amount is, and then we potentially have to add it into your debt to income ratio. So those karma things are not hidden. They're not hidden. Another not so obvious red flag. Not so obvious red flag. So something else that we see come up a lot. A lot of times we all have had issues or have issues with our credit, right? It happens. It happens in life, right? And you've either had some type of credit repair done, or you've disputed an item which you're trying to get off. What you need to do up front is to contact all three credit agencies and ask them to remove the dispute verbiage from your credit report, because it's no longer negatively affecting your credit in terms of what's on there. So it could increase your score artificially. What I mean by that, once you dispute something, let's say you had a cell phone bill, and you disputed it because you was like, hey, this is not the balance. This is wrong. I want this off. It's not accurate. And you dispute it. Once you find out, hey, XYZ cell phone company is not taking that bill off, and you say, I'm done disputing it, that doesn't automatically come off your credit. You have to call and have the dispute verbiage removed. And what happens sometimes is where it's taken off and it affects your score, and your score goes down because now it's no longer being disputed. I ask for that to be done up front, simply because if it goes into underwriting, the underwriter is going to ask that to be done. It typically takes between 72 hours to be removed from your credit, and then we have to re-pull your credit score. So if we do it in advance and up front, then we won't run into that problem, because that's 3 days that you lose on your file, because the underwriter is not going to accept it back with that information on there. The other thing is that, let's say you're working with a lender that charges for credit reports up front, then it costs them to pull your credit without those disputes on it, and then they're going to charge you again. So if you have disputes, or you've been through credit repair, or even if you even think you may have disputed something and it may not be off, I would contact all three credit agencies and ask them, hey, could you please remove all dispute verbiage from my credit report? And then they will all give you a time frame. One will give you 24 hours. I think the other two were, one's 48, one's 72 hours, and then you potentially be notified. After that 72 hours is done, I would go to annualcreditreport.com, because that's up to the minute, accurate on terms of what's on your credit. It doesn't give you a score unless you pay for it. Annualcreditreport.com, and that'll be in the link. That link will be below, and see if those disputes were removed from your credit. Sometimes it takes multiple times in doing it, depending on the person you get on the phone, whether they did what they were supposed to do or not. So I would make sure you do that ahead of time. Hopefully that answered the question. Those are some of the biggest red flags that I see, other than money being deposited into an account, and now we have to verify and trace the source. That's the other thing. Medical bills and students focused on as far as credit, debts versus income. I'm not sure of your question, Christine. If you can reword it for me, I can help you. Why is it looked at as a negative if you don't want to put down money but keep as much in your pocket? I'm thinking about having more money for rainy days. That's a good question. It depends on your score. It's not necessarily negatively looked at, but let's take it from a different. I'm gonna give you a different standpoint that was explained to me. So let's say you have, it's credit score based for one thing. So let's say you have a 640, 650 credit score, and you're looking for a down payment assistance program that you qualify for, and you're looking to get a gift from a family member, and you're looking for the seller to pay some closing costs, in hopes that all of that covers all the money that you need to purchase. Looks great that you're not bringing any money to closing on your behalf. What we're looking at, and what Fannie Mae or FHA, USDA conventional is looking at, hey, this person has a score that qualifies. It's marginal. They don't have a lot of credit history. They don't have a long credit history. So why don't they have any money? You see what I'm saying? So part of it is also, okay, cool. If you got money in um, the bank along with those things, that's going to give a different reading than if you don't have any money, but all of your down payment assistance is taken care of and your closing costs. Because if something happens and you are in a position where you may lose the house, if you have nothing invested into that purchase, it's easy for you to walk away. If you have money invested into it, you're probably going to think twice as to, hey, I don't want to lose X amount of dollars, so I'm going to do my best to try to keep this property. And then just sometimes it just the way, the findings come out based off of credit history and assets. It's good if you can get those things paid and then you have money afterwards, then that's okay, right? That's potentially okay for you to, you know, go into a deal with no money out, no money out of pocket. Um, but that's why. If you have a higher credit score, and I gave you those same scenarios, and you have somewhat of a decent history, like time frame of having credit, then it's going to probably approve you and read it. But it's a case by case basis. Not necessarily looked down upon, but it just makes you a stronger borrower that if you can get those three things and you have money left over, whether it's 401k, IRA, or just money in the bank, and you're trying to think of rainy days, then that's fine. I think you can get an approval as long as you have a strong credit report and credit history. If you pay medical bills each month and the underwriting team sees that, will those medical bills be added in your debt to income ratio? And if so, do they add the entire balance or the monthly payment? So they add the monthly payment in everything. When you're purchasing a home, we look on a monthly basis. We look at how much you make on a monthly basis, what bills you pay on a monthly basis. So medical collections, if it's a debt, I believe it will be counted in to your debt to income ratio. However, if you have the ability to do a pay for deletion in advance to get those medical bills off your credit score, it could potentially boost up your credit score, and then we don't have to use that into um, your debt to income ratio. But if you do pay, it's called pay for deletion. And make sure you ask for that. They're not going to automatically give it to you. You have to ask for the pay for deletion in order to do it. Okay, speedy typer. Is there a focus on medical bills and student loan debt to be paid completely off to zero to qualify for a mortgage? No. So, in the case of, let's see. in the case of medical collections, if you're not paying anything on medical debt and it's on your credit, we don't necessarily take a look at it. So you don't have to. We look at it, but it doesn't factor into whether you can purchase or not purchase, right? Student loans, yes, because it's whether it's private or it is government, it could become a lien or a judgment, and it's debt that's owed. And unless your student loans have already been forgiven, at some point you're going to pay some type. We have to think that you're going to pay some sort of payment. So if you are looking to purchase if you're looking to purchase and use FHA, then and you have a 0% payment, $0 payment, then we're going to look at and we're going to automatically utilize a 0.5% of the balance. If it's conventional, we're going to look at 1% of the balance. VA, we're going to look at 5% of the balance, and then we're going to divide that by 12. That's the easiest way for me to explain it, and that gives you a monthly payment. So if you're on an income-based repayment plan or income-driven repayment plan on any of these loans, for FHA, you definitely have to make sure it's above a 0 payment. The same for VA. Conventional, if we close with Fannie Mae, they will accept a 0 payment, but you have to have some type of repayment plan in place, or we automatically default to the percentage that their guidelines adhere to. Can you talk about purchasing a home now, but making a permanent move in 5 years? What does that look like for financing? So let's say you're in Virginia and you want to move to Florida, but you want to purchase now. Most likely, you're not going to be able to purchase it as a primary residence. That will probably be something considered as a second home or an investment property. The difference is a second home is 10% down requirement. Investment property is 15 to 20%. And the difference between those two with primary is between 3%. Well, no percent if it's USDA and VA, but 3% to 5% if it's conventional or FHA. And some people say, well, how will they know? When you sign the application, it's going to say, do you intend to move into this property within 60 days? And that's when you sign off for that and say yes, and your intention is to move into the property within 60 days, that's the only way you can buy as a primary residence. If you have no intentions on moving into that house in 60 days, it's going to be a second home or investment property. I would not chance it. I would not try it. And if, as the lender, if I know, and I'm going to ask a bunch of questions, if I know that you don't have any intentions on moving in, I won't do it as a primary residence. I advise you to do it as a second home if you're going to visit from time to time, which most people do, or an investment property if you just want to get it in advance and have something to where you may want to retire to or relocate to. But it's going to cost you more money. There's no down payment assistance program for second homes or investment properties, and there's going to be more money out of pocket. But it is possible to purchase something now and then make the permanent move in 5 years. It's just not going to be considered a primary residence at the time of you purchasing it now. Is there any special criteria for working in a state and purchasing in another? Um, Kind of touched on it in your previous question. If you work in New York and you're looking to move to Georgia, if you can work remotely from Georgia at your job and your job can verify you can work remotely, yes, that's not a problem if you're working in another state, person in another. If you're working in New York and you work in a warehouse and you can't, work remotely, or work in a medical field, you can't work remotely from New York and Georgia, then it's going to be a second home or investment property. But you can purchase in another state. You don't have to live in it. It's just the way that you purchase it. Sorry, I skipped your question. I have a few. 3 loans I'm paying and also saving for a home for next year. Is it better to pay off the loans or save the money for the down payment and closing costs? That's a great question. Um, Depends on what your debt to income ratio is with those 3 loans included. So even though you're looking to purchase next year, I would reach out to a lender and get a consultation and work on seeing about getting a pre-approval, because your debt to income ratio may be okay with those 3 loans included. And if it's not, and then if it's going to be next year when you purchase, you may have to come up with a game plan on how, okay, I'm paying off these 3 loans, and now I want to still be able to save money for down payment and closing costs. Do you get a second job? Do you get a higher paying job? Do I, do I get a higher paying job? Do I get a second job? How long is it going to take me to pay off these 3 loans? So once they're finished, okay, I've got a year I'm giving myself. It takes me 6 months to pay these bills off. So that gives me 6 months to take those payments and continue to save. So you definitely have to have a game plan, because it's one thing to pay those bills off and have them help you qualify for more. It's another that if you need money for down payment and closing costs, even if you can get down payment assistance, that doesn't guarantee that the seller could pay, or that it takes care of the closing costs. So you want to make sure you are able to save. So I would get with a lender and get a game plan and let them advise you on what you should do in that scenario. Hey guys, real quick, I want to reset the room. I am answering buyers' questions pertaining to home ownership. Whatever question you have pertaining to home ownership, I am here to answer it. If you're watching this channel or you're new to the channel, it doesn't cost you a thing to hit the subscribe button. Do me a huge favor, and I appreciate it. And if you're watching it now, if you could, and you're enjoying the information that I'm providing, if you could give me a thumbs up and like this video, I would be greatly appreciated. A few other things. We have a Facebook group that I post in 5 times a week. We give tips, tricks, we ask trivia to make sure you're listening to the lives and listening to my information and able to regurgitate and educating yourself on the process. And you remember, as well as a weekly newsletter that we send out with information pertaining to real estate, what's going on in the market. If you happen to miss a live or a video, we notify you, hey, this video came out, click this link here, and it takes you to the video. So all the information for the Facebook group will be below, as well as the weekly newsletter. Just to give you a heads up, the weekly newsletter, we don't spam you, we don't sell you information, and we only talk about real estate items or things that are going on that can help you and educate you on the process. See. I'm trying to get a mortgage soon, but the 3 personal loans I'm paying at the same time to be saved for a down payment. Which of the 2 is more important for an FHA loan? Uh, the link will be below, or send me an email. I put my email in the chat. I'll do it again for you to reach out to me to set up a call, because it's going to be based off of your income. It's going to be based off your income and assets in terms of how long it'll take, and then we may be able to strategize and figure out what makes more sense to move forward to. How long is a pre-approval good for? So typically for me, a pre-approval is good for 45 days. After 45 days, I typically reach back out to the buyer and I get updated pay stubs and bank statements to make sure that we still have the same amount or the money that we need in the bank or saving to get money in the bank, and to verify that you're still working and getting your income without any changes, as well as making sure that, hey, in that 45 days, have they gotten a raise? Have they worked more overtime? Just to kind of see. But the credit report is good for 120 days. The pre-approval technically could be good as long as you continue. It's good for a while, as long as you continue within that 120-day period of time. We're going to update the pre-approval as we go along by asking for updated pay stubs and bank statements. If it goes beyond 120 days, we have to repull credit and have the updated stub. So it could go on for a while, just depending on what you're looking for and in your time frame. Hopefully that makes sense. All right. Think I got all the questions answered so far. So if you're watching the replay, we're discussing first-time home buyers questions pertaining to the market. We went over questions pertaining to the best time to purchase. We went over market rates, went over payments. We've covered a lot of topics in this. So another thing, so when you have your credit pulled by a lender, let's say we pull your credit. Experian, TransUnion, and Equifax are paid by other companies as a lead source. And let's say it's 50 companies, right? 50 companies that pay to get leads. I'm not selling your information. They do. They don't sell your information. They send notification that, hey, Judy Smith just applied had her credit pulled for a mortgage. And then all of a sudden, you start to get emails, text messages, and calls from those lenders because you've applied for a mortgage through us. Now, they're called trigger leads. Trigger leads mean that your credit was triggered for mortgage, and now you're going to start to get a bunch of calls from people who say they either work with your lender or want to try to get you a mortgage. A lot of them have a deceiving way of reaching out to you saying, oh, I'm working with, this is such and such, I'm working with your lender to get your loan approved. And then they pause and you say, oh yeah, let's say example is me. Oh yeah, Kevin, if you can send me your documentation, do not do it. Matter of fact, in the link below, after this video, there will be a number and a website for you to opt out of those communications. Do this 5 business days prior to you reaching out to a lender to have your credit pulled. Listen, you will thank me later because you're going to be bombarded, and those jokers are they are relentless. They're going to continue to call you. They're going to email you. And if you're in a position and you're not paying attention, they could potentially deceive you. I've seen people who say they've had their credit pulled by that lender, and it cost them, they had to pay up front. And they was like, hey, was this used? Like, no, we already pulled your credit and we went over your application. I wouldn't send anybody else after you to get your credit repulled unless I notified you myself. For whatever reason. So you definitely, or if the information is not in the link because I have to find it and put it in, Google opt-out option, and then follow the instructions on how to opt out of receiving those spam calls from people, text messages. Does it get rid of everybody? I don't think so. But does it get rid of a ton of them? Yes, because they're going to constantly bombard you and bombard your phone, and it's very annoying. So watch out and maybe Google trigger leads or opt-out options for calls, and then also put your number on the do not call registry so you won't get those calls, or at least it minimizes those calls. Does it matter if you're married or not? Same last name on the mortgage. Doesn't matter whether you're married to the person you're going on a mortgage with. If you go by yourself, doesn't matter if you're married or single. If you're going on a mortgage and you and the person, both have the same last name Lambert, but it's your sister or your brother or your mom or your child, that doesn't matter either. Do both of you qualify is the question that we're going to ask. Or we're going to see. So it doesn't matter whether you're married or not with the same last name on a mortgage. What debt that's not on your credit is included in your DTI? The two biggest ones, if you have an IRS tax bill, that's included in your DTI, and child support. Child support. If you pay out child support or alimony, and those things don't pop up on your credit, we calculate those into your debt to income ratio. My intent is for you to be a lender in, Soma State of New York Assistance Program has many programs, but they steer the buyer to specific lenders. I'm not entertaining any credit pull from them. Cool. So, I appreciate it. If you have a VA loan, you don't need a down payment assistance program. Like, it's not any better. Um, you just need to bring your own closing costs. And if you don't have your own closing costs, you can ask the seller for or save. Um, if it's a down payment assistance program in New York that we don't participate in, sometimes when there's down payment assistance programs, they want you to physically be in that state, or they want you to be signed up for that program. Alfonso, I think we need to grab a call because it's been a while. So let's see what we can do and how to streamline the process for you and make sure you got a good understanding. But I appreciate you always jumping on here, jumping in the Facebook group, and adding great information, asking amazing questions. It's been very helpful to me, man. I appreciate it. But we need to grab a call and update some information and see how we can get you settled in. Is it better to wait to purchase a new SUV after obtaining a mortgage? Yes, because if you buy a vehicle now, that money, let's say the SUV payment is $750, that's $750 less of a mortgage that you can purchase. When you buy the house and you've closed on your mortgage and you're now a new homeowner, and then you buy the SUV, you're more likely to get that SUV than you would be getting a house. So I always tell people you can always get the house first and the vehicle second, but it's not the same going the opposite direction. So yes, do not, if you intend on purchasing a home, do not purchase a vehicle. It's not going to help you. Yes, cool. You found out that you got a 700 credit score when you purchased the car, but now you qualify for $750 less of a home. That's a great question, Christine, because people don't know. So I appreciate you asking now instead of later on. The Facebook page link will be in the description below. After this, if you give me a few minutes. But if you want to go to it now, it is Homeownership Success. Homeownership Success will be the link, or you can click on First Time Home Buyers Q&A with the People's Lender. But yeah, definitely reach out and join that. Hey guys, you guys have had great questions tonight. Definitely, before the other question starts coming up, definitely do the trigger lead option. I'm telling you, you're going to thank me later. You're going to thank me later. You need to know the number for the opt out, so that you don't get bombarded with questions. Just to kind of recap, something else that I've been getting questions is, hey, should I wait until interest rates go down? We don't know when rates are going down. Last year, at the end of the year, the Federal Reserve said, hey, at first they said, hey, we're going to cut interest rates maybe 6 times in 2024. Then they announced, hey, it's probably they speculated that they were going to cut interest rates about 6 times in 2024. And then Jerome Powell came out, who's the chairman of the Federal Reserve, and said, hey, we're going to cut interest rates at least 3 times in 2024. We are halfway through 2024, and rates have not been cut, so interest rates have not been cut. So you don't want to hang your hat on interest rates being cut. If they do get cut, that's great, and you qualify, that's great. We most likely will see more competition in the market because more people qualify. Um, Someone said, when is the best time to buy? It was yesterday. When's the next best time to buy? Today. So, if you can buy now and you can afford the payment and it fits into your criteria of what you need, I would say buy now. Hey, if you don't qualify now, I'm not saying that you're never going to qualify. You just need to put together a game plan to get in position to purchase so that you can, in fact, become a homeowner. Some questions that buyers ask me, hey, how much do I need? That's going to be dependent upon what you're looking to buy. If you're looking to purchase a home and it's $500,000 and you're going FHA, you need 3.5% of $500,000 for down payment, and probably on that price range, probably another 3.5 to 4%, depending on your state, for closing costs. If you are looking to purchase, using conventional financing, then you're looking at, 3 to 5% of that $500,000. And I just preference people, hey, make sure you try to save as much money as you can. Purchasing a home is not an inexpensive thing. And I know it sounds great when people say, oh, I got into a home with $0, but that's not every situation. Sometimes there's times when down payment assistance programs run out of funds. There's times when down payment assistance programs change guidelines that you no longer qualify for it. If you take a hit in your credit score, you don't qualify for it sometimes. And then sometimes they just happen to go away. Right now, I've been seeing a lot of programs come out, and it's trying to help buyers, but you still want to have money to put into the deal, even if it's just your closing costs. There's no guarantee that sellers are going to pay the closing costs for you. And if they do, you still want to have the funds, because if the property does not appraise for where it should be, one of the first things the seller is going to do, because they're taking a loss in what they expected to get, they're probably going to reduce or not give you any closing cost assistance as well. At that point, you're in the deal and you want to make sure, hey, I can afford this, or I can now buy it. You want to have the option to be able to purchase if something goes wrong, where let's say you don't qualify for the down payment assistance anymore, or if the seller no longer can pay the closing costs because the property didn't appraise for what it needed to. Miss Christine, how about Habitat for Humanity program? Are they flexible? Habitat for Humanity is a totally separate program. You have to apply for those. And you have to, I know from experience, you have to spend a certain amount of years in those properties. You typically can't move out and rent them out. So if you want to find out about Habitat for Humanity, you want to reach out to your local Habitat for Humanity office and set up an appointment to talk to them. It's a great, could be a potential great option, but it takes a long time. You have to build with a group of people, and you have to each help build each other's homes, and you can't move in until the last person's home is complete. So depending on your time frame and when you need to move in, and if that's something that sounds like you want to do, then you may want to check into Habitat for Humanity as well. Mr. Al Thompson, my latest question on the property taxes. How careful do I need to be when the new purchase is much higher than the last tax assessment? Could I end up with a much higher tax payment? So the taxes, taxes are based off of typically the assessed value. You'll find out what the taxes are. You can ask your agent to ask the seller what they currently pay in taxes, or you can have your agent look it up because it's public knowledge. It's public knowledge as to when the what the taxes are. Say example, the house that you're buying from the person is above, say 65, and they don't pay school taxes, and you're not 65, you're going to have to pay higher taxes than that person because you're paying school taxes. In reverse, let's say the person you're purchasing the home from isn't 65 and they pay school taxes, but you're 65, then the next tax season you can apply for the exemption and you won't have to pay school taxes. So that could potentially reduce your taxes. You'll find out, or you can have your agent reach out to the attorney and see if they can give you an estimate of what your taxes would be on, 123 Main Street in New York, right? Just find out what the taxes are going to be, and then you'll have an idea. However, once you get into the house, even if you do your home exemption, they still could charge you more in taxes later because property values are steadily increasing. So with property values steadily increasing, municipalities and counties are constantly reassessing taxes, and you're seeing an increase in it. There shouldn't be a huge shocker because on my end, when I look at a property for a client, not look at a property, but when I do some digging for the payment for the client, I try to find out what the taxes are. And if they seem too low based off where they are, my team and I do a little bit more research to get you as close to where you're going to be tax-wise as possible. Brown Sugar, sorry you missed the live. But you can go back and watch the replay. The replay will be posted. You can watch the live from there. And hey, if you're not subscribed to my channel, you can get the notifications of when I go live. And if you're not a part of the newsletter that you subscribe to, I always send out in advance an email saying when I'm going live and what time. But no fret, you can go back and watch it, and you can gain the information. And it's from the live. If you have some additional questions, you can send me an email, or you can comment in the chat, in the comments if you have questions, or if you want to jump on a call with me. My contact information will be below. I got a few more minutes, guys, and I'm going to be out of here. But I do want to reset the room. If you just joined us live, I'm answering all your questions on home ownership. Whatever you had or have, even though the live is stopped, my contact information will be below for you to reach out to me, schedule an appointment. If you have questions, that's a basic question, you just want to ask it in the comments. I do check my comments. And guys, I appreciate you for coming out tonight and helping me make this live a success. See if I find the current taxes on 78K properties now selling for 76. So it's going to be based off of that assessed value. When they do the reassessment, it may be after you purchase the home. So I wouldn't fret, or I would just get your agent to ask the listing agent to ask the seller, what do they currently pay in taxes? And then they should be able to help you with that. Can I purchase a foreclosure with a FHA loan? You can purchase a real estate owned property, which is an REO, which is the process after the house has been foreclosed on with an FHA property. I know what you mean, but I just want to specify the difference in the two. Foreclosure is when it's been foreclosed on and it gets sold on the auction steps of the county. Once it's purchased, and let's say it's taken back by the entity or HUD, then it becomes an REO, real estate owned property. Can you purchase one with FHA financing? Yes, you can. It just has to meet the standards and guidelines for FHA once we do the appraisal. But yes, you can purchase a real estate owned property. No, you cannot purchase a foreclosure on the steps of the courthouse with an FHA loan. Just want to be clear. Hey guys, thank you for coming out. I appreciate you. The link to contact me will be below. Give me a few minutes to get everything situated. My help is not here today, but thank you. God bless, and have a great night.